Happy Friday, you melon heads. Hope you guys are well. Another week for the history books. Wasn't really that big of a week, although we got that much anticipated rate hike this week. And, well, not a whole lot happened, did it? Seems like markets just plowed along. Onward and upward. Up we go. What's the worst thing that could happen? Do not answer that. And here we go. Now we're into our new tightening cycle, which historically does not end well for us. We've been through a couple of tightening cycles here in the U.S. over the last decade or so, and none of those have gone so well. But maybe this time will be different, right? This time's different. What's the worst that could happen? Anyways, hi, Mom. Hi, Dad. I love you guys. Thank you for watching. And hello to all the familiar names who are in the chats already. Hey, Silver Truther, Ralph Potts, Mike Kathman. Thank you, Mike Kathman, for the super chat while we were waiting, sir. I really appreciate that. Mike says, thank you for your vids. My pleasure, Mike. I really love doing this, and thank you for your support of the channel. I see Nicole Post. And Neil Hahn, where are you, Neil? You got to be in there. There's Neil. 22 minutes ago or a half hour ago, Neil was there also. All right, happy to see you guys. I think it is that time. We're going to shrink my big, fat melon of a head and take a look at some of the charts that we have going on today. And while we're shrinking my big, fat melon, won't you please smash that like button? Consider subscribing to my channel if you have not already. And right now, we are looking at the S&P is up about 40 points for the day. Started down quite a bit and just slowly grinded higher throughout the day. The Dow now up 135. The NASDAQ having another good day, up 240. Why not pile into some tech stocks that don't make much money? How about some overpriced exercise bikes over at Peloton? Give Kathy Wood your money. What's the worst that could happen? Oh boy. Seems like people are just doing the same old thing, expecting a different result. I don't know. Crude oil, look at that, at 104.75. I told you guys, didn't I tell you earlier this week, that oil would not stay in the 90s for long? That chart made no sense to me. That oil actually came down below the price it was at before the war in Ukraine even started. That made zero sense. So I actually bought more of my June call options in XLE earlier this week. That's actually the only trade I made this week, was I bought some more of my XLE calls. Otherwise, I just kind of sat this week out and didn't do a whole lot. But those are doing better now. I was a little early last week. I got into some calls in GDX and GDXJ. Looks like I was early by a couple of days. I could have got those cheaper, but I'm still sitting on those. And let's see, we've got a couple of other things going on here. Commodities. We talked last week about how commodities were trading sideways, that they were going to consolidate for a while, which was inevitable after that monster run to start the month that coincided with the invasion of Ukraine. And we still seem to be doing that. Looking right now, gold is down about 1.1%. Silver's having a tough day, down 2.2%. Just about all the metals are down. Platinum and palladium are trading about sideways. Crude, as we mentioned, was back over 100, now at 104.56. Natural gas still struggling in the mid-4s. And nickel, check out nickel. Talk about how to ruin a perfectly good market. Nickel down again 12% today. So for the last 3 days in a row, within a couple of seconds of the market opening in London, the nickel trade has traded all the way down till it hit the circuit breakers, and then they shut everything off. And this is still the mess that was made by that Chinese big shot who bought all those nickel futures, or sold all those nickel futures short, and then refused to be margin called, and JP Morgan's not allowed to lose money, so we had to shut the market down, and it's just been an absolute mess. Which, by the way, if you ever have a second, go look at how the London Metals Exchange actually functions. It is hilarious. All right, the London Metals Exchange, I kid you not, it's this circular red couch where these guys just sit there very stoically and look at each other, and then occasionally they grab their paper and they shout at each other. Meanwhile, you have all these other guys in the background who are sitting there with two phones, talking into each different phone to all their guys, and then they're sending all these weird little hand signals to the guys on the couch, speaking in their code so that the other traders don't know what they're doing. It is really hilarious, and they trade in like 5-minute runs, 5 minutes for each type of metal. I was watching some of this week, just figuring out how the London Metals Exchange works, and I was really blown away. I was just cracking up laughing the whole time between the guys on the couch and the guys with the phones doing this. There's got to be a better way. there's got to be a better way to trade this stuff. And look, the London Metals Exchange, the reason why it exists is to provide efficient price discovery, right? It's this big giant pool of liquidity, both of cash and of metal, where the world can come by and we can very quickly arrive at the balance of the equilibrium between supply and demand. Well, the London Metals Exchange no longer does that. They no longer function in this way, at least not for nickel. So it's useless. There's no reason for the LME nickel market to exist until they get their act together. And one by one, they're going to lose their customers if they keep that nonsense up. All right, I've got Mr. Steve Whitus in the super chat. Thank you, Steve, for supporting the channel. And he says, RE stock markets, buy the dip, sell the rip. I understand this is opinion and not financial advice. Steve, I can't speak in very broad market terms right now, okay? This is not a buy the dip market, okay? This is a stock picker's market because the days of the index going blindly higher across the board, in my opinion, are over. You need to make the right picks, all right? So I can only tell you what my strategy has been, and it's been the same since the fall. My strategy has been to raise cash and has been to get into basic trades like necessities, food, energy, and precious metals, all right? And those have all done really well since the fall. I'm not changing that strategy yet. The days of buying an index fund blindly and just watching it make new highs day after day, I think those days are behind us. There's a lot of people who are still trading that way. In my opinion, I think they're going to get absolutely burned when this market turns south. And I don't know when that's going to happen. My gut tells me sometime around June. I tend to be early, so maybe it'll take longer than that. So again, buy the dip, sell the rip. You have to be more specific. You have to pick your sectors. You have to pick your specific stocks or your specific targeted ETFs. You know, I like to go into energy ETFs or precious metal ETFs. I don't like to do the wide index funds because the market is not going to move as a whole anymore. You have to pick the right sector. So I would just say do your DD carefully and don't just cast that wide net and send it out there. Thanks again, Steve, for the super chat and for supporting the channel. I appreciate that very much, sir. Okay. Now, I have some charts to show you guys because I've been watching precious metals very closely this week. And here is the silver chart, and this is a chart going back to 2020, okay? Let's make sure you guys can see okay, and you can. But going back to 2020, right, here's the big sell-off after the unfortunate health situation, and then that big run-up in the spring all the way through August of 2020, and then all the price smashes that we saw in 2020, and we traded downward, and then we had the silver squeeze, and of course the rigging of the markets that suppressed the silver squeeze, and we've been in this consolidation pattern ever since. Now, I had Brian Zarb on the channel a few weeks ago, and Brian had drawn this flag pattern here, and he had mentioned that we needed to see a breakout or back test and a move higher, and that we got that. So now that I have you guys all here and you're looking, we're actually going to retire that flag pattern. We're not going to look at that anymore because we have broken out and retested and moved higher. And what I want to do is draw your attention to this new channel that I think we're in that's really developed since the fall. And I want to zoom in a little bit on this one because this channel that we're in, this is back, I don't know if you guys remember when I did that video in late January after somebody had bought a few $100 million worth of silver, or a few 100 million ounces. I forgot what it was. It was a few million ounces. And I had mentioned that I wasn't FOMOing into silver yet, that I wanted to see that back test, and that back test had failed. And of course, we came back down. But now we found this new bottom here. And this new bottom and this new top end of the band. And it looks like we're trading in this range quite a bit. We just bounced earlier this week off of this lower band. That's a couple of times now we've bounced off this lower band. And the reason why I'm pointing out this trend is because this trend has us, let's zoom out a little bit more. This trend has us getting to $30 sometime between mid-April to mid-May. All right, that's when this channel crosses $30. And if we break above that $30 mark and we hold above that $30 mark, then it is onward and upward, in my opinion, towards the 50s. And I think we're long due for that move. And right now, just if we stay in this channel, we're going to be at 30 sometime around mid-April to mid-May within that 1 month time frame. So keep an eye on this silver chart, folks. We're going to be watching this band very closely. Right now, we're towards the lower end of the band. And precious metals have been trading a little bit sideways these last couple of days, so we could be due for a move higher back up into the 27s next week. But keep your eye on this chart. I saw this one yesterday, and I was talking this over again with Brian Zarb, and he was seeing the same thing. So maybe it's about time to have Brian back on the channel one of these days soon. Brian, if you're listening, send me an email, brother. Let's set that up. Okay, I see we got another couple of guys here in the Super Chats. Thank you guys very much for all the Super Chats for supporting the channel. I appreciate that. We've got Mike Binder from Robin RC Models says, lockdown shipping and break supply chains, number 1. 2, short commodity futures with funny money until supply shuts down. Number 3, leave Africa and Asia without enough food. This sounds like the elitist playbook of what our WEF and our ESG mandating benevolent elitist overlords have been doing, because you're exactly right. First, they locked us in our houses and shut down production and then flooded the markets with free money. They shorted commodities and they rigged the markets. And now we've got wars breaking out. We've got this fertilizer crisis, which has been an offshoot of our energy crisis, which is only getting so much worse. We're going to talk a lot about the fertilizer and the food situation. My God. We're running out of time to address this. And, yeah, Mike, I wish I could tell you it's something different, but unfortunately there's some really tough days ahead on the horizon. And again, when I say tough days ahead, for us it means less discretionary spending, less luxury goods, less vacations. For people in other parts of the world, it means burying kids. All right, so this is a very big deal. And right now we're too caught up with sustainable agriculture or fighting climate change or whatever woke issue of the week is dominating the headlines to realize that if we don't do something soon, millions of people are going to starve to death. All right. And that's not a conjecture. All right. This is not some theory. This isn't some, follow the science or whatever hyperbole. No, this is a fact. All right. Food is getting more expensive and fertilizer is getting a lot more expensive and farmers are going out of business. This is a fact. There's a lot of lives at risk right now, and we're putzing around on this issue, not doing anything about it. It's driving me nuts. So again, I've been talking a lot about food security on this channel, folks. Take that seriously. Check out that video I did about feeding a family for under $100 for a month. Go out and get yourself an emergency supply of food, because I'm telling you, these food prices are going a lot higher, a lot faster. Don't wait. And also, I see Mr. Matt, a.k.a. The Cheeseburger, is in the Super Chats as well. Thank you, Matt, for supporting the channel. He says, MMRI sitting at 131.3. Where are we on that trend line for 10-year yield, TYY, and the MMMRI? All right, Cheese, you're a little ahead of my schedule for today. I was planning on going there, but since you asked and since you were so generous with your Super Chat, let's just fast forward right there. First of all, here is the modified Mannarino market risk indicator, and that is currently sitting at a 163 level. Now, the one thing I would point out is they use on this website, and I don't know who runs this website. This popped up shortly after my video was made. They use 125 for the debt to GDP ratio. When I did my video on the MMMRI, the debt to GDP ratio I used was the one from Statista.org, which is about 1.3. All right, so this somewhat understates the MMMRI. Now, there's another one out there that Harry Dan 2 did on TradingView. That one uses a higher debt to GDP ratio based on what the U.S. Debt Clock website says, and that one, in my opinion, skews it a little high. So, we're somewhere in between here, but we're right around the 163, 165 level, which is in the high risk category. And again, every time I bring up the modified MMRI, I have to send a shout out to Mr. Mannarino and to his original indicator, which is currently at 131, right about mid-band in the moderate risk indicator. And I'll be honest with you, right now, my gut tells me we're actually a little more moderate, because I don't see the reverse repos dropping. I don't see these coming down. And it feels like the reverse repos need to go away before we can have any kind of a banking crisis or a big liquidity event, because reverse repos is excess liquidity in the system. So right now, looking at the reverse repos here, we actually had this little bit of a spike the last few days, and then I remembered that today is actually quadruple witching. We'll talk about quadruple witching in a minute, but the third Friday of the last month of every quarter is quadruple witching. And if you look, going back since the start of this reverse repo crisis, we've had these little bitty spikes right around this time, around the quadruple witching, and then we get another spike at the end of the last month of the quarter. Here's in March of 2021. And then in June of 2021, all right, in mid-June, right before quadruple witching, we had this big spike, this big run-up, right where my cursor is. And then at the end of that month, another big spike. Fast forward to September. Mid-September, we get this run-up here. This is your quadruple witching over these days. And then at the end of September, we get a big spike. We had the same thing in December. Again, the last month of the quarter. Mid-month, we get this run-up leading into quadruple witching, and then we get that big spike at the end of the quarter. So what's going on right now, I think we have quadruple witching, and the end of the quarter is somewhat masking a decline in the reverse repos. All right, we should be seeing a decline in reverse repos, but we're in the middle of this quadruple witching spike, which we would get anyway. And I think we get another spike in 2 more weeks at the end of the quarter before these reverse repos resume sideways, at least, probably much lower in my opinion. So that just occurred to me today. And by the way, quadruple witching is this concurrent event where basically on the same day you have the expiration of stock index futures, stock index options, stock options, and single stock futures all simultaneously maturing. And what happens is you tend to get a ton of money moving back and forth throughout the market on a day like that, and that causes spikes in these reverse repos. So I didn't see that one coming. I probably should have seen that coming when I was wondering why the reverse repos weren't dropping the way they were. I didn't realize quadruple witching was coming up on us. So that's that answer. And then real quick, since you mentioned, Matt, in your question, here's where we are on the chart. The 10-year yield, we've come down a little bit from the 2.2% we were at earlier this week. Zoom in a little bit here. We did cross above it, but now we're back below it. So we're going to watch this level, and I just want to emphasize again, this is not a dead man switch. The second we hit this line, it's not like we stepped on a landmine and something blows up in our face. It just means that the conditions are present for some kind of bad event to happen in markets. And I just want to point back here, all right, back in 2018, we actually crossed over this line a couple of times, and we stayed above it for a few months before we actually had that end of the year event in 2018 that drove rates lower. So again, this could last for a few months. My gut tells me June, and I tend to be early. So, hey, maybe it's not until September. Maybe we get a repeat of something like we had back in 2018. So, Matt, thank you very much, sir, for your super chat, for your support of the channel. I really appreciate that, brother. And I see you got another one up here. Bought my first physical silver last week and bought 200 liters of diesel before the 50 cent per liter price spike, too. Congratulations, Cheese, on your first physical silver. I got my pocket silver right here in my hand. This was my gift from Jim Lewis at Wall Street Silver, who gave me my silver Troy, my 1-ounce generic round from SD Bullion, and I love this thing. This is my new pocket silver that I pull out at cocktail parties when people ask me about buying silver. And tell me, Matt, the first time you held it in your hand, what kind of silver was it, by the way? Was it a bar? Was it a round? I'm curious. But the first time I held physical silver in my hand, it was a 10-ounce bar, and I just remember going, oh, the first time I held it. It was such a cool feeling, and I've seen that in other people when they hold a bar of physical bullion for the first time, especially with silver, when they feel the weight of it. It's you can tell something clicks in their brain, and I've even seen it on CNBC when some of the CNBC guys held up bars for the first time. They're like, oh, wow. And they can't take their eyes off it, even though they need to regain their composure because they're on live TV. So congratulations, Matt, on your first physical silver, and thank you very much for the super chat. You are now officially becoming your own central bank. Your money is safely preserved out of their financial system where their games can touch it. So congratulations on that. And again, I just bought myself a little bit of physical. I bought about 2 weeks ago, a couple of weeks ago. I took delivery 2 weeks ago, 100 generic silver rounds, 1-ounce rounds. Those are my favorite. And a couple of ounces of gold as well. I maintain a 100-to-1. I buy 100 ounces of silver for every 1 ounce of gold that I buy. It's just my personal preference. It makes the numbers easy to keep track of. And I see Mike Kathman. Again, sir, thank you for your super chat and for your support of the channel. Guys, I really appreciate this. He says, do you think JP Morgan has 1.2 billion ounces of silver in hold? So there's 2 ways to answer that, Mike. Asking about JP Morgan's 1.2 silver ounces in the hold. No, they don't own 1.2 billion ounces. It's not JP Morgan silver. JP Morgan's vaults may have that much silver in it. I doubt it. What's the COMEX inventory is like, I think 340 million ounces is what COMEX says is in all of the registered vaults. Now, JP Morgan is the biggest. No, that's the eligible vaults. I'm sorry. And JP Morgan is the biggest of all the vaults. And they're the custodian of the SLV Trust, so they have the most holdings. But it's not JP Morgan silver. It's the SLV's silver, or it's their client's silver. How much silver JP Morgan themselves actually owns, I don't know that. And it's nowhere near that 340 million ounce number. And it's a good bet it's nowhere near the amount of silver that they owe. Because over the last few weeks, we've seen a lot of people have been taking delivery off the COMEX. A lot of people have been buying up the silver, and it's been JP Morgan who's been putting fresh silver into the registered category to try to keep the market liquid. JP Morgan has been defending these low prices. I don't know how much longer they can do it, how much more silver that they can move from eligible into registered to keep that liquidity afloat. But I do know that it's been JPM that's been defending it, and they certainly don't have 1.2 billion ounces. No way. All right. Are they using their client's silver? Are they rehypothecating? Right, that's the term where they basically sell someone else's metal and give that person an IOU. Almost certainly that there's a lot of that going on. But thank you, Mike. I really appreciate the super chat. Guys, all you guys, I appreciate your generosity. Thank you very much. Mr. Devin Bryans, I see you on there as well. Thank you, sir, for the super chat. And he says, is it just me, or should the chart use real interest rates instead of nominal interest rates? Interesting. Real rates are still negative. Shouldn't this drive the market higher? Could you do a study on this? All right, Devin, that one's going on the board. That's interesting. I'm gonna write that one down. I'm gonna say the chart in quotes, but with real rates. I'm not sure where I would get that data. There's probably, a TIPS or something chart that I could use to approximate that. I don't know if that's available in the 10-year format, but you're right. Real rates does give you a more accurate reflection of market conditions. And right now, real rates are still negative. They're still deeply negative. And that should be pushing precious metals higher, although real rates have been negative for a couple of years now. And precious metals have been trading sideways. There's two ways you could look at that. You could say real rates are bound to move higher, or you could say that there's a coiled spring beneath precious metal prices that are going to propel those prices much higher. And I think the latter is true because interest rates are climbing, but right now, inflation is increasing faster than interest rates are, which means real rates are heading lower. So, these quarter point rate hikes a month, I see CPI numbers, even the bogus CPI numbers, which we all know are BS, right? Those numbers are going up a heck of a lot faster than the Fed funds rate is going up. So that's a very good question, Devin, and thank you very much for the support of the channel and for the super chat. I really appreciate that. And maybe for Tuesday morning or for next Friday, I'll have that chart ready. I'm gonna look into that one. But thank you very much. I appreciate that, sir. All right, let's see what else we have got going on here in the charts. Now we got a little bit ahead of ourselves. We did look at the silver chart, and I just wanted to point out the gold chart. Now I saw something similar today was on I Love Prosperity's channel. He had Steve Penny, the silver chartist, on, and they were looking at a gold chart. And Steve drew something very similar to this on his chart on that. I highly recommend you check out I Love Prosperity, by the way. That is an excellent channel, and they talk a lot about precious metals as well. This is this consolidation that gold has been in since, again, 2020, since that August high, and we've been trading sideways. We've been in this flag pattern. We've seen this low around 1675 has held a couple of times, and now we've broken out of this trend, and we're heading higher. And I'm going to put another line on here. I should have drawn it ahead of time, but I'm going to put a line right around $2,010 because that is the weekly closing high going back to 2010. And so far we've gone above that, but we rejected that level and we came back down in this sideways pattern that we've been in. But if we get a weekly close above this 2010 time level here, I think gold is off to the races, and we're probably looking at a move on par with the scale of the move we saw in early 2020, which would bring gold somewhere up around $2,500, $2,600 in very short order, like over a span of a few weeks, maybe a few months. But that's once we get a weekly close above 2,000. If we get a weekly close in gold above 2,000, then look out, folks. Gold is going to rip higher, and I mean in a big way. And I'm just going to point out that according to this chart, that happens right around the time silver is poised to break above 30 on that other channel that I just showed you on this chart, sometime around mid-April to mid-May. So keep an eye on these charts. Keep an eye on these important thresholds, 30 in silver, 2010 in gold. Because if we break above those, it's going to rocket really fast. All right. Now you're going to see JP Morgan and the bullion banks, they're going to try to defend those levels. They'll probably come up with some more of the shenanigans that they've used in the past. And we've seen whenever things get tough for the big dogs, they change the rules to their own benefit to screw retail investors. We very well may see that happen again. But watch those levels, folks. And I'm telling you, who was it that just said it was Matt Cheeseburger, I believe, who said he just bought his first physical silver? Don't wait until that happens. If your plan is to buy physical precious metals, which is a good plan, by the way, not a financial advisor, not financial advice. But if that is your plan to buy physical precious metals, don't wait until silver breaks 30. Don't wait until gold breaks 2010 on a weekly close. Because when that happens, you're going to see that inventory on all those websites is going to dry up like that. You're going to see the inventory at your local coin shops gets taken off the shelves because the premiums are going to go up considerably when that happens because there's going to be people FOMOing in. And then a lot of these local dealers, they're not going to want to sell at those prices. They're going to want to sit back and wait and see where it settles at. So they're going to pull inventory off the shelves. In other words, physical gold and silver is going to become unobtainium when that happens, right? And God forbid if that's the straw that finally breaks the camel's back over at the COMEX, then forget it. You'll never get your hands on physical gold and silver. It'll be like the nickel trade where nobody knows what the fair market price is, and the guy who's got a junkyard full of nickel is now the richest man in the neighborhood. So keep an eye on that. Keep that in mind. If your plan is to buy physical precious metals, don't wait and then FOMO in. My approach has always been to dollar cost average in a little bit at a time. It's always been my strategy. I do the same thing with cryptocurrency, and that's just, I can only give you my opinion in what I do, folks. Again, not a financial advisor. This is not financial advice. All right, there's a few more things that I have been watching over the last few days and months. Another one is corn. You've all seen my corn videos. Some of them were a little corny, pun totally intended. And let's just get my melon out of the way so we can zoom in a little bit. This is the corn ETF, ticker CORN. And last week I drew this chart. We were back here last week on the 11th, and I had mentioned that we were probably going to trade sideways. I had drawn this little flag pattern and said we're going to bounce around in here before we break out above, retest, and then move higher. And so far, that's pretty much exactly what we've done. We're still in that pattern. I'm looking for a breakout next week and a retest next week. If I see that successful retest and a move higher, then I'm probably going to add to my position in this corn ETF, even though I have January 2023 call options in this one. They're already up about 75%. They were up over 100% a few days ago. But if I see a breakout and a successful retest, I'm going to be adding to my position in this because the situation in food markets has just gotten so much worse. More on that in a minute. But keep your eye on this one. And again, it's just one I'm watching. And another one I'm watching is LNG. That is Cheniere Energy. Again, these are all things I have a position in. I always want to be honest with you guys. I'm not just shopping my book around here. I'm telling you what my trades are. But I've been talking about this one since back in October. And this one is starting to look a little bit like the silver trade, a very similar channel. We just broke out of that consolidation. And right now, we're right around the lower band of this channel that we've been in since about November. And last week I had mentioned I sold 2 weeks ago at 135. I bought back in last week at 130. Maybe I was a little early, but I'm still in that. I haven't made any other trades in that. I'm looking for this one to head higher in the not too distant future because I think this one is going to be back in the 140s in relatively short order, probably within a couple of weeks. Again, this company, Cheniere Energy, they buy natural gas here in the United States. They liquefy it, they load it onto ships, and they sail it over to Europe, where they can sell it for 5 to 10 times as much as they paid for it here in the States. And this company is going to be just a money printing machine in the next few years as the situation with the Russians and the natural gas market continues to deteriorate. And Europe just has their head way up their backside when it comes to energy policy. They're never going to achieve energy independence. So their only option really is U.S., Qatari, or maybe even Australian liquefied natural gas. So this company is going to be making serious bank for a couple of years into the future. Also, these are all commodities plays, so inflation just feeds into this one. Okie dokie. Now, with that, let's take one quick look back at markets and see where we're at right now. We're about 15 minutes away from close. The S&P is, let's refresh this, now up almost 50 points, still marching higher. The Dow is now up 220 points, about 0.6% higher. And look at the NASDAQ, up almost 2%, 262 points, going up. Oil, 104.72, and gold and silver still headed lower on the day. And the 10-year yield is about 2.14. Again, we got a little bit of breathing room between here and that 2.2 threshold. All right. Now, I want to talk a little bit about the food markets and the fertilizer situation, folks, because this situation just is not getting any better. This is from a couple of days ago. Actually, this is from 2 days ago. This is Progressive Farmer, and this is showing DAP fertilizer prices. That's diammonium phosphate. It's one of the most common nitrogen fertilizers that's out there. And looking at this chart here in the corner, the purple line is your 2020 prices, relatively flat. The green line is what prices did over 2021. And you can see in the fall of 2021 how they just started heading straight up and really didn't take much of a breather. And now the red line over here, this is the beginning of 2022, and we just continue to head higher. Again, folks, this is next year's food continuing to get more and more expensive, and we're not doing anything about it. We cannot fix this problem until we get more natural gas and we get more fertilizer plants built. All right. Without those two things, and the time to do this was 6 months ago, it's already too late to do this. If we don't do those two things, then we have a global food crisis on our hands. And in my opinion, the global food crisis has already started. We just don't know it yet. It hasn't really hit the retail level yet, but it's all but certain because farmers cannot afford to fertilize like they did last year. And if farmers can't afford to fertilize, they're going to use less fertilizer. Their crop yields are going to go down. That's less food production. That means food prices are heading higher. All right. And this, I cannot stress this enough. This is probably the single biggest threat to human life on this planet at this point. I mean, this is going to kill a lot of people. And if you think I'm kidding, take a look at this on Twitter today. I just saw this one. This is African dependence on wheat from Russia and Ukraine. All right. Russia is not going to export any wheat this year. They've already said that. And Ukraine can't export any wheat because Russia will sink any ships that try to leave the Black Sea. And this is all the countries in Africa and how much wheat they get from Russia and Ukraine on a percentage basis. And you can see Africa, on average, gets about half of all of its wheat from just those two countries that are not going to be exporting anymore. That means half of the wheat that goes into that entire continent is now off the market. And look at Somalia. All right, look at Egypt. What is that? Benin is that other one. Look at Sudan. I mean, these countries, 70, 80, 100% of their wheat comes from these two countries. And it's gone now. How are those people going to eat? And these are parts of the world that are already food insecure. Right? There's already famine in a lot of these countries. And now look at what's going to happen to their food supply. That's why I've been saying for a long time now, since this war started, that most of the body count from this war is not going to be in Europe. It's not going to be on the battlefield. It's going to be in the poor parts of the world where a minor increase in food prices means death for a lot of people. And we're sitting here talking about how can we achieve sustainable fertilizer production without adding to carbon emissions when millions of people are at risk of starving to death this year or next year. And we have idiots making decisions about how to address this crisis where their priorities are carbon emissions and not keeping people fed. And I'm telling you folks, do not wait. Get your own food security addressed first. It's the only thing you can do. I've done that video on how to get a cheap supply of non-perishable food. Invest in yourself, in your own ability. Don't go out and try to become a farmer overnight, okay? Because most people who first try gardening or vegetable gardening end up pumping a lot of money into it and get very little yield. But practice being a gardener. Put a few tomato plants in the ground this summer and just see what you get. Get a little bit of knowledge. Watch a couple of YouTube videos and learn this, right? You're never going to become self-sufficient overnight. It takes a lot of practice. It takes a lot of skill and a lot of research. And if you think I'm kidding, a lot of people tried and failed over the millennia. All right, you're not going to figure that out in 2 days. All right, I don't care if Michael Bloomberg thinks farmers are stupid and all you have to do is put the seeds in the ground and water it and poof, you're a farmer. No, it's a lot harder than that. All right, so do a little bit of practice. Invest in your own food security, folks, because it's going away. That's all I can tell you. Food security is going away. It's going to get more expensive for us. It's going to get unobtainable for a lot of people. And our leaders are not addressing the problem. They're outright ignoring the problem. And just look at a couple of these other headlines here. Food crisis grows as spiraling prices spark export bans. I want to emphasize on export bans because what happens when our leaders make lousy decisions that leads to a food shortage? Their solution is almost always price controls. And price controls do not work. Price controls make things worse. All right? I'll explain that in a minute, how they make things worse. Here you go. Algeria bans export of food. This is in Africa News dated a few days ago. Egypt puts 3-month ban on food exports, according to a report. This is March 10th. Food protectionism is spreading as Hungary bans grain exports. This is March 4th. One by one, countries around the world are banning food exports. They're hoarding, all right, which means the countries who can grow their own food will survive. The countries who can't will starve. We're already seeing this playing out. Now, this doesn't work, all right, because when you ban food exports, yes, you achieve some temporary reduction in prices, at least in your domestic markets. But what that also does is that hurts your farmers. And the last thing we want to do right now is hurt farmers. For the love of God, we cannot hurt our farmers right now. Because if our farmers are not allowed to export food, that means they have to pay for the more expensive fertilizer. They have to pay for the more expensive fuel. They have to pay for the more expensive parts and equipment and labor. But now they can't sell their crops into the more lucrative export markets, which means those farmers are losing money. Or even worse, those farmers are going out of business, and so they're not going to farm next year. And that's what happened in Venezuela. One by one, Venezuela nationalized industries and banned all these exports or put all these price controls in place, and one by one, industries in Venezuela failed, and now you have an entire nation of dumpster divers. All right? And we're seeing these stupid mistakes repeated right now all over the world because these short-sighted, narrow-minded politicians are only worried about their poll numbers this week or next month, and they're not worried how they're going to feed their population next year or the year after that. All right? So export bans are happening all over the world. Globalism is breaking down. It's failing. I've been talking about this since the fall. It's going to get worse, folks. Keep your eye on these stories about food export bans and know this is not going to solve the problem. It's only going to make the global food situation worse, let alone the fact that food importing countries now have nowhere to turn. And so the price for anything that's on the export market is just going to go through the roof. Devin Bryans, thank you again for the super chat, sir. I see he says, when do you think the corn price will really accelerate? Do we have to wait and see that the fall harvest is weak? Is corn your favorite trade right now? Corn's probably not my favorite trade right now, Devin. And again, thank you for the super chat. I don't know that corn is going to like rocket or accelerate higher. Let me zoom out here, shrink my big fat melon and bring up the chart. Let me bring up a corn chart here. This is the commodity, not the ETF that I'm going to bring up. Give me 1 second. And I want to zoom. Give me like a 1-year chart. So all these dang pop-ups, man. All right, so here's a 3-year chart of corn, and I want to make sure you guys can see. Here, let's put me over here. So do I think it's going to like rocket higher? Well, Devin, I guess that if you look at this chart, I mean, the answer is it kind of already has, right? Corn has rocketed higher. It started back in 2020. We had that ridiculous run in commodities right around this time last year in the spring, and then we came back down. That was when the lumber story took off. And now look at this big cup that we just formed. And, a lot like the precious metal charts, here we are. If we close above those previous highs, then we probably rip a lot higher. Now, what could be the catalyst for that? Honestly, right now, if things continue the way they are, this chart goes up and to the right steadily no matter what. My personal opinion is that the harvest from South America has already come in bad. The drought has killed their second harvest already. We'll hear about that story soon. We've got more countries are banning exports, which means you're going to have more market share is going to be coming towards food exports from the U.S. That's going to drive this higher. And I think the harvest in the fall is going to be a lot less this year because farmers are going to do fewer fertilizer applications. So all those things combined, that's why I bought these call options all the way out to January of 2023, because I just see so many, like every few months, I see another potential catalyst to take this chart higher. So is it going to rocket? Maybe. But even if it doesn't rocket higher, it's going to keep grinding up and to the right, in my opinion, for at least another 6 to 8 months, possibly a couple of years. And again, I don't see our leaders doing anything that's going to make one shred of difference in this trend. So I think you've got time. Now, is that my favorite trend? Probably not. My favorite trade right now is energy. And really, the corn trade is an offshoot of the fertilizer situation, which is an offshoot of the energy situation. So this is you could look at this like a derivative, I guess. I think the energy trade is the more compelling one at this time. That's why the only trade I made this week was I bought more options in XLE. That's the ETF that tracks oil stocks. I'm in XLE. I'm in ERX, which is a levered oil ETF. I'm in LNG, which is an arbitrage play on the natural gas markets. So those are the trades that are probably my favorites right now, but I do like the corn trade also. But thank you again for the super chat, sir, and for the support of the channel. I really appreciate that. And I've also got Mr. Vacation Time 247. Thank you, sir, for the super chat, who says 137 people watching, 56 likes. Hit that like button. Well, thank you, Vacation Time. I appreciate you reminding people to give the like button a big smash, or as I like to say, inflate the like button for the YouTube algorithm. And why not drop a comment? Well, you're commenting right now. And subscribe to my channel if you're new here. I appreciate that. So thank you, Vacation Time. And I've got Mr. Matt again. Cheeseburger says, farmers in New Zealand are being pushed harder and harder by the government here. Taxes and all sorts of other regulations designed to crush them. It's crazy. Well, Cheese, if you abuse your farmers, if you act like farmers are this problem that needs to go away, eventually you're going to get your wish. All right? And, nothing grinds my gears more than these. I'm speaking in American terms here, but we have coastal elites here, people on the right side and the left side of the country near the oceans who just love to look inward at all those stupid backwards hicks, as they say, in America, who they just fly over back and forth between New York and Los Angeles, looking down on them at how silly their squares look from their planes, not having any idea how hard and how much work goes into and how much actual science and planning goes into producing the food that they eat. They just wish these silly backwards barbs in flyover country would keep their mouths shut and do what they say and keep them well fed. Well, those people on the coast are in for a rude awakening. When I was at the Speak Freely event in Dallas with the Economic Ninja, which was a fantastic event, by the way. Eventually, we're going to do another one of these, folks. I have to tell you, we don't have one planned just yet, but when we do, I highly recommend it. It was just a great event. I had such a great time. But I watched a presentation that Joe Brown from Heresy Financial did, and it was really good, and it was eye-opening. And he mentioned something that happens during a hyperinflationary scenario. You get this reshuffling of skills and valuations in the economy. You see, right now, the economy places more value on sophisticated skill sets. Now, what do I mean by that? I'm talking about like computer programmers or lawyers, right? Sophisticated skill sets, we'll say, college degrees, high-level degrees. Right now, those folks make most of the money. But during a hyperinflationary scenario, when people are worried about how they're going to keep their house warm, how they're going to keep their kids fed, they no longer value the programmers that much. They no longer value the attorneys that much. Now, the farmer is more valuable. Now, the guy who knows how to keep the truck running or keep the car running, he's more valuable. So you get this change in valuations where basic or more rudimentary skill sets get a higher valuation than the sophisticated skill sets get. And if you think I'm kidding, all you white collar guys who are watching right now, think about the raise that you got this year. All right. Did you get a raise that kept pace with the rate of inflation? No, you didn't. I bet you didn't. I sure as heck didn't. All right. White collar workers, their standard of living is dropping very quickly right now because their raises, their pay is not increasing with the rate of inflation. Now, if you run an auto mechanic shop, if you fix cars at your own business, your costs have gone up, your labor's gone up, but you can raise your prices now. So you have essentially, through your pricing power, have given yourself a raise that has kept pace with the rate of inflation, which means that more basic skill is now more valued than the white collar skilled, or at least the trend is returning more towards a balance. So what does that mean in aggregate? Like extrapolate that over time, over a couple of years. Let's say the inflation problem continues to get worse. That means the one who benefits most is going to be that person who has a basic skill that provides some kind of necessity. And that's another reason why I mentioned early on that, hey, spend a little time investing in yourself and learn how to grow something or learn how to fix something or provide some basic skill, something that will make you more valuable if a hyperinflationary scenario ever comes to pass. You're not going to develop that skill overnight. If you think you are, you're arrogant and you're full of yourself because it's hard. It's really hard. Anybody who thinks farming is easy, go work on a farm for a couple of days and you're going to be sitting there with your back hurt and your fingers bleeding and say, oh, this job sucks. Trust me, it's hard and you will not get good at it overnight. And that's why just invest a little bit of time, do a little bit of research, practice, start developing that now. And that was a really good presentation that Joe Brown did from Heresy Financial. And it was eye-opening. So even if, say, you're watching this channel right now and you don't have a lot of money to invest in yourself, right? Say you don't have a lot of money to put into the market or you're risk averse, you can still invest in your own skills. You can still invest in developing that side hustle or that side gig or learn how to fix or maintain something so you don't have to pay someone else to do it. These are all things that as this reshuffling of values happens in an inflationary environment can be to your benefit. So, man, that was a wicked tangent you sent me on, Matt. But to your point, the way they're abusing farmers in New Zealand, they're going to regret it. I guarantee you they live to regret it. And very soon the farmers in New Zealand are going to have all the power, and those coastal elites, or whatever you call them in New Zealand, are going to be dancing to their tune because they're not going to have anything to eat. And again, I want to thank you very much for your support of the channel. And he says, also Cheeseburger says, Tim Pool just dropped a video right now about the incoming food crisis. Word is getting out. You know, at risk of getting myself swatted, I like Tim Pool's podcast. I've been following him for a long time. He's a really sharp guy, and he is a target for people. I mean, he's had, like, SWAT teams have shown up at his house and his office, like, several times in the last couple of weeks. They hate him. Let's just put it. They hate him. They hate free thinkers like Tim Pool. And even Russell Brand now is getting target from they. And Russell Brand is not like some kind of right-wing conservative guy. Russell Brand is actually an uber liberal. He just knows how to think for himself. And so he sees what's going on in the world, and he sees the elitist power grab, and he realizes, hey, this isn't a left-right thing. This is an us and they thing, they being the elitists. So I'm actually having a lot more respect for Russell Brand, even though take most issues, most political issues, and me and him probably differ pretty severely on them. But there's a lot of common ground I see developing between me and a guy like that because he sees this power grab and this manipulation that's going on right now and how we're being broken up into groups and told we should hate each other, all about them maintaining their power and their control. And Tim Pool is another voice like that, probably from the opposite end of the political spectrum. But Tim is preaching a very similar message right now, and they hate him for it. So thank you, Matt. I really appreciate the support of the channel, brother, and everything you do. And now, real quick, guys, we are going to revisit the market because it is now 4:04. The market is closed. Let's see where we ended up for the day. Make sure you guys can see, and you can. Looks like the S&P closed up 51 points, or 1.17%. The Dow closed up 273, or almost 0.8%. And the NASDAQ, the big winner on the day, up 2%, almost 280 points. Sure, give all your money to Kathy Wood. Whatever. What do I know? Not a financial advisor, not financial advice. Don't give all your money to Kathy Wood. Personally, I think that fund is going down in flames. Again, see also the reshuffling of values back towards basic skills and away from sophisticated skills. And that's what you get during a hyperinflationary environment. All right, guys, it is now 4:05. Markets are closed. Oh, and I see, wow, that's a mouthful, that name. Curry way downtown bang. Wow, that is a mouthful. Thank you also for your super chat. I really appreciate that. Guys, thank you for all your ideas. Thank you for watching this video, for listening to me and my soapbox. Again, do not sit around and wait for this food crisis to get worse. Invest in yourselves. Invest in your own skill sets. Buy yourselves some non-perishable food. If you're into physical precious metals, don't wait for that big breakout and FOMO in at the last minute when it becomes unobtainium, dollar cost average in, and have some fun this weekend. All right? Remember, every day in our current state is a good day, is a gift, and it's not always going to be like this. If you're watching this channel, chances are that you are at least inclined to agree with me that there are difficult times ahead. Well, those difficult times are not here yet, so we still have good times to enjoy. So spend some time with your loved ones, have some fun, but at the same time, invest a little bit in yourselves. Do it now. Prepare so that when it gets here, you're better off, and we can all come out of this better off. Guys, I want to thank you for your time. Thank you for watching. Don't forget to like and subscribe to my channel. And thank you to my Patreon supporters for making this channel possible. There's a link in the description below to that. And until next time, live small and dream big.